welcome. Now, ITI Mutual Fund has launched the Divinity Equity Long Short Fund under the new SIF, that's the Specialized Investment Fund Framework. To understand what this means for investors, I'm joined by Rajesh Bhatia. He's CIO of ITI Mutual Fund, and my colleague Pranit Mathur. He's a Senior Mutual Fund Analyst from Value Research. Welcome, gentlemen.
Thank you.
Thank you.
Rajesh, let's start with the big picture. SIFs, they are a completely new addition to India's investment landscape. So in simple terms, what gaps in the market are SIFs designed to fill, and why did India need this format now?
First of all, thank you for having me. Look, SIF is an umbrella on which you have very similar products that you have in the mutual fund. So SIF is not the product. SIF is the umbrella under which you have various products. So I just want to make that distinction because people are tending at this moment, maybe it's too early, that's why, that X firm is launching an SIF and so is Y, but they don't realize that the products are totally different. So for that benefit, I just want to reiterate, SIF is an umbrella where you get very similar products to that you get in the mutual fund, which is equity-oriented funds, fixed income funds, and hybrid funds. So just like a mutual fund umbrella, you get different type of products. There are a few variations though. One, it's increasingly meant for more sophisticated investors, and therefore the minimum ticket size is 10 lakhs and above. That's one. The second is this ability to short, naked short, right? What is a naked short? This ability to short a stock that you don't own. So in a balanced advantage fund or an arbitrage fund, you go long a certain stock and then you can hedge the stock. So let's say if you own 100 shares of HDFC Bank, we can equally short 100 shares of HDFC Bank, and that's a perfect hedge, right? But that's not a naked short. Naked short is if you did not own an HDFC Bank in your long portfolio and you can still short it, that's a naked short. So that flexibility has also been kind of designed so that people can take advantage of even stocks that are declining. There's a phrase that, even in a declining market, there are stocks that are rising, right? That's the favorite phrase of a long only manager. But the corollary to that, which is a favorite phrase of a long short manager, even in a rising market, there are falling stocks. In an age of technology disruption, right, the need to kind of short has just gone up. What do I mean by that? So, you can remember the examples of, Kodak films, right? Or broadcasting channels in India, or radio in the context of media consumption. Radio is far less consumed today than probably, what our parents consumed or even we consumed, long back. Today, most of the people are on different platforms, whether it's YouTube, Instagram, etc. So there are businesses which are declining as well. So you can short those opportunities. And in fact, if you're going long and short companies, you're actually bringing the portfolio risk down as well. So this is a fairly good evolved system to take advantage of businesses which are deteriorating as well, which hitherto was not possible in a conventional long-only market like ours.
Right now, coming to your fund, the Divinity Equity Long Short Fund, most investors, they experience the market through long-only funds.
Yeah.
What kind of return experience are you trying to deliver here that's different?
So what is the purpose of a long-short equity fund, right? Why bother? India is a very conventional long-only market. Globally, a long-short product is a $1.5 trillion product, right? And the best brains on Wall Street actually are associated with hedge funds, right? So it's only in India now that talent is coming in to the long-short business. And if you talk to various AMCs, when you ask them, why are you not launching an SIF? They'll say, we don't have the talent. Because this is a very skilled product. And the most experienced and the best talent in actually Wall Street goes to managing long-short equity products. So coming back, what is the purpose of a long-short equity fund, particularly like ours? And remember, I want to point out once again, we are an equity long-short product in the SIF umbrella, right? Don't compare us with hybrid funds, which will also be there in the SIF format, which others are launching, right? The objective of our equity long-short product is to generate an asymmetric return profile. What do I mean by that? You want to participate on the upside in the equity markets, but you don't want to participate on the downside in the Indian equity markets. So let us say I'll give you some numbers and it'll clarify what the value add is, right? So let's say Jan 23 to September 24, markets went up 42%. It was a bull market, right? In that 42% Nifty rise, let's say a long short product rises by 44%, right? And then subsequently the market came down. We know the markets peaked in September 24. October to, let's say, February, March of 25, the market came down by 14%. Mid caps, small caps corrected probably 20 or 25%. A long short product would have corrected by about 3% or so, right? So what is the cumulative effect of that? Jan 23 to March 25. Market has gone up by 22%. The long short product mathematically has gone up 40%. You have generated 18 percentage points of alpha with the market with far lower risk and far lower volatility. So the key thing is asymmetric return profile. Participate on the upside, but don't participate as much on the declining side of the market. That is the purpose. And over a long period of time, it helps you to beat the market with lower risk and lower volatility.
Right. So while you did describe Divinity as aiming for asymmetric returns, meaning participating in the upside while limiting the downside, can you please elaborate a little on how does the portfolio construction with its mix of long and tactical short positions help you achieve that?
So the skill sets required in the business to manage and navigate the markets are you have to have a damn good understanding of the top down.
Mhm.
You you have to have a good understanding of bottom up, which is finding stocks which generate alpha on the long side and the short side. And third, you require a very active risk management DNA, right? On the top down side, as you're navigating markets, you of course need to decide what is your exposure to equity markets. Top-down understanding helps you to generate that. What do I mean by that? So when you're your skill sets required on the top-down are you need to be familiar with where are we in the economic cycle, market cycle, valuation cycle, and most importantly, sentiment cycle, right? And you're looking for what is that risk which will disproportionately impact markets, which I need to guard against. And therefore, you can bring your net equity exposure down. So the top down helps you to kind of navigate the markets with what kind of risk you need to put on the overall exposure level. So if you're looking at a COVID period, clearly you want your exposure to be as low as possible. And if you are navigating Jan 23 to September 24 in 18 months of a bull market, you want to extend your equity exposure to as high as possible. So one is exposure management. Second is stock picking. My learning is the best alpha is created by stock picking, right? It's at a time. So our philosophy is, of course, that we want to back good business models, right, which are growth oriented, predictable, and profitable, right? So there are businesses which are less cyclical. So let's say I'm just giving you names, but these are just random names. Let's say Bharti Telecommunication or HDFC Bank, or SBI Life, Bajaj Finance. These can be typically what I would call predictable businesses, multi-year businesses, growth opportunities, profitable, right? And from time to time, they're available at valuations which we think are reasonable. Those are typically your long book, and that's the skill set that you require on the bottom up. Similarly, you need to find out from time to time what are the companies that are getting in a challenging industry environment. So let us say, recently we knew banks, NBFCs had overlent on the MFI, microfinance segment. And suddenly the NPAs spiked up. And you could identify, okay, which is the bank or the NBFCs, which are where the NPAs are going to spike up and the valuations don't reflect this deterioration in fundamentals that have taken place, right? So you could have shorted those opportunities, right? So we knew the capital goods sector did extremely well until September 2024 when the governments were spending a lot of money on capital expenditure. So the capital goods stocks did extremely well. But as soon as they reduced that spending, some of these companies were available at 80p, 90p, right? And they were vulnerable to a decline because suddenly their order books or growth rates would slow down. Those become shorting opportunities as well. So, so that's the bottom up skill set that you require. and a risk management DNA. As you're navigating this cycle, you need to manage your exposures in such a manner that you can participate on the upside and not participate on the downside. The first dharma of a long short equity product is protect downside. If a long short product doesn't protect downside, why bother? The risk return of a long short product has to be different from a long only product. Otherwise, there's no purpose of a long short product.
Right, but shorting hasn't always been easy in India. So, how significant is shorting in your strategy, and how do you use it in strong bull markets like the ones we've seen recently?
So, shorting is a skill set. Lot of the Indian managers are not used to shorting,
Hmm.
right? And they lack that skill set. Particularly, when is shorting most helpful? Of course, you short for three reasons. At least I short for three reasons. One, I short to generate alpha, right? So let's say if I'm bearish on the paints business and all those stocks are quoting at 90 PE, right? You can short those businesses because you know that the economics is going to deteriorate because of massively increased competition, but the valuations don't reflect it. And by the way, we are in a slowing down growth of that business, right? So one is you short for alpha where you're trying to generate a positive return. Second, you're shorting to reduce the beta of the portfolio, right? So if I'm short, long something and short something, the overall beta of the portfolio anyway comes down. It reduces the risk of the portfolio. And the third reason why I short is because I'm far more risk aware. So something like a COVID takes place, a long short manager is far more aware that there can be a downside to the market. It's not a matter of skill set alone, it's just the hat that you're wearing. If a long only manager were to be wearing a long short hat, he would try to ask the same questions that a long short manager asks in terms of risk that is emerging. But a long only manager is just used to thinking 5 साल में अच्छा लगता है, right? He is not used to thinking, boss, ये risk of a COVID can mean our economy can really take a downturn, right? So he's just a different hat that you're wearing. Like I said, risk management DNA. So those are the three reasons why you have a short book. And of course, it is extremely helpful when you go through a phase like a COVID, when you can prevent downside of such a massive scale.
So, you were talking about risk management. So, which is crucial in such a strategy, not just at a portfolio level, but operationally also. So, what are the key guardrails that you've built in to avoid large drawdowns or sudden swings?
So if you ask Grok or ChatGPT, which is the most consistent long short product in the country, they will tell you it's ITI, right? So we've done this for a long period of time. I mean, I've done long short equity fund investing for 18 years. It's possible that I'm among the most experienced long short equity fund managers in the country, and we have done this consistently, which means including the drawdowns, right? So to answer your question, we have done this consistently, and the skill set that I mentioned, right, which is uh, a risk management DNA, a top-down understanding to understand where are we on the cycle. It's as Howard Marks would say, right, in the Mastering the Market Cycles. If you have a good understanding of top-down, it at least helps you to know whether we are in oversold and cheap markets or whether we are in overbought and expensive markets. That at least gives you some judgment, right? So today, possibly people would be arguing AI is in a bubble, right? So you clearly know that you're not talking about cheap markets. You're talking probably extended markets, right? So at least you have a sense of how much awareness should I have of where the market cycle is, and therefore how should I position my portfolio accordingly. Did you notice Warren Buffett, which is sitting on $380 billion of cash and not participating in the most exciting market in the world today, which is the US? Why does he do that? Because his rule is rule number one, don't lose money. Rule number two, never forget rule number one, right? Which fund helps you to achieve that objective? A long short equity product. He doesn't want to permanently lose capital, right? Because if you lose capital permanently, it can impede or dilute your long term compounding track record. The secret to long term compounding is actually not to lose too much money, right? It is called winning by not losing,
Yeah.
right? As Seth Klarman would say, you can have a 30-year track record of compounding at 15% per annum. On the 31st year, if you lose money, you can destroy your 30-year track record. right? It can go to a mediocre 7%. So let's say you invest in an NVIDIA at $5 trillion valuation, right? And your portfolio comes down permanently. It goes to 2.5 trillion. Why can't it? In March 2025, it was 2.5 trillion, right? So if it goes to 2.5 trillion and you permanently lose capital, it destroys your compounding for 30 years. So we all follow Warren Buffett, but listen to what Warren Buffett is saying. Rule number one, don't lose money. Rule number two, never forget rule number one. And a long short product helps you achieve that objective.
Rajesh, you mentioned that managing risk is one of the key factors of the fund itself.
Yeah.
And from an investor's perspective, can you help us understand who is this exactly for? Who will be the end customer that you want for your fund to be invested in?
So our long short equity product, first of all, is an equity product, right? Second, so in terms of time horizon, ask the question, what is my time horizon for an equity product? It should be similar for my long short equity product. Second, this is a capital appreciation product. It's not an income product, right? So if somebody is totally dependent on using this as an income, is in the wrong product. But somebody is interested in capital, appreciation, this is a product for them. Third, there are people in this market, most sophisticated investors in the market, who are saying, boss, I'm not comfortable with Indian equity valuations, right? That even if things go right for Indian equities, I'll probably make 11 to 12% compounded from here, right? I'm not going to make 18% CAGR from here on a diversified portfolio or a mutual fund, right? But what if things go wrong and then goes up? I will make lesser than 11 to 12%. So a lot of people are saying, if this is such a fragile world that we've entered, should I be paying expensive valuations? So I want a strategy which will de-risk my portfolio, including a portfolio which will reduce the risk. It's uncorrelated to my long-only portfolio. And if the market goes down, it reduces the risk of my portfolio. But by the way, I don't want the cost of this insurance to be 4% return. I still want it to be an equity return. So in case the India story goes up, I still want to participate in this. But I want to, at the same time, if things go south, I want to protect my downside. So it's a value add to my existing portfolio. And the need for a product like this, according to me, has just gone up dramatically.
So for someone who already owns diversified equity funds and supposedly has a portfolio of completely diversified mutual fund portfolio, how should they think about allocating to Divinity? Should it be viewed as a diversifier or a stabilizer or a purely return enhancing allocation? I can understand that managing risk is very important, but how should they try to include that Divinity SIF in their current portfolio?
So if the diversified portfolio is all equity diversified portfolio, then your risk return is going to be along with the market, right? So your
Right.
upside and downsides are going to be correlated to the market. Now, a lot of people don't appreciate this, but I want to share something with you, right? Today, the Indian equity market psyche is, because thanks to what we have experienced, that market cycles declines in India can last only 12 months. And after that, we are off to the races again at 15% per annum, right? So somebody who's as old as I am would know that 96 to 2003 markets were flat. Or January 2008 to actually Jan 2015, if you had given money to a long-only manager, your returns were zero. 7 years of no return. Now imagine if you are a 50-year-old, 60-year-old or a 70-year-old, worse. And you are thinking, look, I have a 5 crore portfolio and I'm 50-year-old and I'll compound at 15% per annum, which means I'll make 4 times my money. And at the age of 60, I'll have 20 crores. That's good enough to retire on. What if that 10-year period is what we have seen in the past, right? Where you make no returns, right? You make mediocre returns. What is the mitigant in your portfolio that can still, assure you, okay, even if things go south before it goes up, there is something in my portfolio that mitigates that overall risk that I'm looking at. So to that extent, it's a risk mitigant to your entire portfolio. And people don't remember long phases of zero returns in the Indian equity markets.
Right, Pranit, you've also analyzed hundreds of mutual fund portfolios over the years. So, what's that one quality or flexibility that a long short SIF brings that a traditional mutual fund can't quite offer?
Well, as Rajesh rightly pointed out in the beginning, if you look at the Indian mutual fund landscape, almost everything is long only by design, as mutual funds are simply not allowed to take naked short positions, as he rightly pointed out in the beginning. So they can only hedge their existing holdings and thus not able to generate returns from those short positions. So this long only structure, if you take a very long horizon of maybe 40 years, it would have served very, very well. And if you see the Sensex graph of over 40 years, it has only risen over time. However, those minor corrections is pretty common in the marketplace, and it recurs every couple of years here and there. And whenever those corrections happen, long only funds have very little room to maneuver. As he mentioned, the beta of such funds are very close to 1, which indicate that they fall as much as the market, and sometimes they even fall more than the market itself. So this indicates that they are unable to protect the downside very, very well. And if a fund manager feels that the valuations are not correct and not worthy of being entering right the moment, like the example of Warren Buffett, as Rajesh rightly pointed out, and if valuations are stretched, then such investors have only one option, is to sit on cash. They'll sit on cash of about a longer period of 20-25% of their portfolio, and it comes with their own sets of downside trade-offs in as well, because in the longer run such cash allocations can prove to be a little difficult for the fund manager to maintain, and such returns will get compromised over time. And that's where a product like SIF or a long short equity fund can help fill that kind of gap, because it gives the fund manager wider toolkit to play with. They can participate in downsides and try to benefit from that falling market, which otherwise mutual funds are simply prohibited from doing so.
Right, Rajesh was also mentioning the periods of no return that Indian equity markets have had, 95 to 2003, 2008 to 2015. So, in general, how do you see the market dynamics playing out in India, and what do past trends tell us about the market phases?
Fortunately for India and Indian investors, by and large, our Indian markets have been growth driven. If you take a couple of instances out of the Indian markets, all major corrections have been followed up by a long stretches of bull runs. And this has been purely based on the wonderful corporate earning cycle that we have seen, the government push, the economical fundamentals being aligned with the benefit of the companies itself, thus being able to generate better bottom line numbers and so on and so forth. And this has turned to a massive rally in Sensex as well. However, what one of the wonderful ratios that we can see is if you divide the bull phase rally by the bear phase period. So if you take periods out of such outlier phases of 1993 to 2003 and 2008 periods out, you can see that by and large all minor corrections have been succeeded by a very long period of bull rallies. So for 2020 example, the COVID crash you can take, the 3 month correction was followed by a 1.5 year rally that significantly more than made up for the entire correction in itself. So while corrections are common and they come and pretty irritate investors pretty much, they are very short-lived here in India. So that's a pretty benefit that investors have been able to enjoy for a very long period of time. And mutual funds have been able to rally that very, very well over a very long period of time.
Right, Rajesh, before we wrap up, if you had to explain the purpose of Divinity SIF, the equity long and short fund, to an investor in one simple sentence, what would that be?
Asymmetric return profile. Participate on the upside and don't participate on the on the downside. That is really the purpose. Any long short fund that doesn't, equity long short fund that doesn't have this purpose or objective is of no use to you. Even if they don't deliver that, then there is no point in being in a long short equity fund. You might as well be in a long only product. I'll just mention one thing. And I think, Pratik also mentioned this. Look, you know, I know when market downturn takes place, it's always, that's the time people remember asset allocation. I promise you, that's my experience. Um, when a downturn like 2008 took place, and people realized that portfolio has just, you know, uh, gone down to a quarter of what they were,
Yeah.
right? They said, not everybody can emotionally handle that. I know fund managers which liquidated their entire portfolio at the bottom of the market. Forget about sophisticated investors. The emotional drain when you lose 75% of your capital, you know, that's the time you actually remember asset allocation, right? Forget at that time, February and March of this year, I received a lot of calls from people who had large money to say that markets have gone down by 30 or 40%, right, in my mid cap portfolio. And I don't know whether I should be liquidating my entire portfolio or liquidating part of my portfolio because, I'm not very comfortable with the policies that are emanating. So, so the answer to those kind of emotional responses to your portfolio is have an asset allocation policy and have a product which kind of mitigates some of the emotional drain that you can witness from large drawdowns. So I think to that extent, a smart asset allocation strategy, which includes a long short product, which by the way is not telling you that I will make only 4% per annum, right? It's not a fixed income product. It's not the cost of insurance is not I will be sacrificing my equity orientation. So at least from that perspective, it is still going to be an equity oriented product for the medium term.
Great. With that, time for us to wrap up this chat. Thank you both of you for joining in and helping us decode this new format of investing. It's going to be interesting to watch how investors respond to this. Thank you.
Thank you. Thank you so much.
Thank you.